China's rise as a global power didn't happen through military expansion or political alliances. It happened through debt specifically, America's debt. For more than 2 decades, the United States has financed its growth, consumer spending, and government programs by borrowing money, and China became one of the largest buyers of that debt. This financial link isn't symbolic. It has real consequences, shaping trade, policy decisions, and the balance of power between the world's 2 largest economies. Most people don't see it because the mechanism looks technical: treasury bonds, trade deficits, currency controls, and foreign exchange reserves. But the effect is simple. As America imported cheap goods, China collected the dollars. Instead of spending them, it lent those dollars back to the U. The cycle repeated every year, making American consumers dependent on Chinese manufacturing and American finances dependent on Chinese lending. This isn't about a dramatic takeover or an imminent collapse. It's about influence built slowly through routine economic decisions. Influence that affects interest rates, supply chains, and the options available to American policymakers. When a nation becomes accustomed to borrowing from a rival, it loses part of its ability to act freely. The dependence doesn't appear suddenly. It grows through years of convenience and short-term decisions. Understanding how this relationship formed and why it matters requires looking at the origins of the U.S. China financial connection, the choices each side made, and the quiet leverage that emerged from those choices. Every economic relationship begins long before anyone realizes its full meaning. The financial link between the United States and China is no exception. Its roots stretch back decades, forming quietly through political decisions, industrial shifts, and global changes that neither nation fully controlled at the time. To understand how China eventually gained leverage through America's own debt, we have to begin at the moment when their economic paths first crossed in a meaningful way. In the years after World War II, the United States dominated global manufacturing. Its factories supplied the world. Its currency anchored international trade. Its financial system set the rules. China, by contrast, was emerging from decades of instability and internal conflict. It had no global role, no modern industrial base, and no financial ties to the Western system. For much of the mid-20th century, the 2 nations lived in separate economic worlds. That separation began to narrow in the 1970 seconds. China, under new leadership, started opening its economy to foreign investment. It did so slowly, cautiously, and with strict controls, but the shift was unmistakable. The United States saw an opportunity, a vast labor force, untapped markets, and the possibility of integrating a large population into the global economy. For American companies, the calculation was simple. Manufacturing in China meant lower costs. Lower costs meant higher profits. And higher profits meant pressure to keep expanding operations overseas. At first, the movement was modest. A few companies, a few factories, a few special economic zones along the Chinese coast. But the pattern grew quickly. By the late 1980 seconds and early 1990 seconds, American firms were relocating production lines, supply chains, and entire industries offshore. The shift wasn't part of a grand geopolitical plan. It was driven by business incentives. Companies sought efficiency, and China offered it. What no one fully recognized at the time was that this change would reshape the financial relationship between the 2 nations. When the United States moved manufacturing abroad, it increased its reliance on imported goods. Those imports had to be paid for in dollars. China collected those dollars and accumulated them faster than any nation in modern history. But instead of spending them freely, China treated them as a strategic resource. To understand why, we have to look at how China viewed the global system it was entering. Unlike many countries that spent their export earnings or allowed their currencies to rise, China adopted a different strategy. Its leaders understood that exporting to the United States could become a long-term foundation for national development, but only if the exchange rate remained favorable and only if the United States maintained enough financial stability to keep buying. That required predictability. It also required patience. China used strict currency controls to manage the value of the renminbi, and prevent rapid appreciation. It reinvested its dollar earnings into US Treasury bonds, effectively lending money back to the American government. This was not an accidental decision. It served two purposes. First, it kept demand strong for debt, which helped keep American interest rates lower than they otherwise would have been. Lower rates allowed American consumers to borrow more and buy more imported goods. Second, it allowed China to store value in the world's most trusted financial instrument. By the time the 1,990 seconds ended, the relationship had already taken form. The United States bought goods, China collected dollars. China lent those dollars back to the United States. The cycle reinforced itself year after year. Each nation benefited in the short term. Americans enjoyed cheaper products and stable interest rates, while China grew its manufacturing base and foreign reserves. The arrangement seemed efficient, even mutually beneficial, but beneath that surface, a long-term imbalance was forming. China was accumulating financial power through the steady purchase of American debt. Neither country publicly described the situation in those terms. American policymakers saw the borrowing as routine. Chinese leaders described their holdings as necessary for economic stability. But the scale of the financial flows was growing, and with it, the potential for leverage. This shift did not happen in isolation. It coincided with broader global trends. The rise of globalization, the integration of supply chains, and the increasing role of financial markets in shaping national outcomes. American consumers became accustomed to low-cost goods. American politicians, regardless of party, found it easier to run budget deficits because foreign creditors, especially China, were willing to buy the government's bonds. China, meanwhile, built the infrastructure of a manufacturing powerhouse: ports, highways, factories, energy networks, and an increasingly skilled workforce. Every dollar it earned from exports strengthened its ability to expand. Every treasury bond it purchased tied the United States more closely to Chinese financial decisions. By the early 2000s, the scale of the relationship had become impossible to ignore. The United States ran growing trade deficits with China year after year. Those deficits were not small fluctuations. They were structural. American production had shifted abroad, and the country relied heavily on imported goods, everything from electronics to clothing to household essentials. China became the primary supplier for countless industries, and its reserves of US dollars grew into the hundreds of billions. The debt cycle was now fully established. The more the United States bought, the more China earned. The more China earned, the more it reinvested in US bonds. The more it reinvested, the more the United States could afford to borrow. When a country becomes used to financing its spending through a foreign creditor, that creditor gains influence, even if neither side openly acknowledges it. This was the origin of the invisible debt relationship, not a deliberate plan, not a conspiracy, but a long chain of decisions shaped by economic incentives. What began as cost-saving measures for American companies and development goals for China evolved into a financial system where each nation depended on the other, but not in the same way. The United States depended on China to fund its deficits. The foundation of the modern U.S. China debt dynamic was now in place. What remained was how this relationship would grow, deepen, and eventually transform into a form of influence that few people saw coming. By the early 2000s, the financial relationship between the United States and China had moved beyond simple trade and investment. It had become the backbone of a new global order. What began as cost-driven manufacturing decisions evolved into a system where the world's most powerful economy grew dependent on the world's fastest-rising economic challenger. The rise of this system was not sudden. It took shape through a series of predictable steps, all rational on their own, all consequential when taken together. China's economic surge accelerated after joining the World Trade Organization in 2001. Membership granted access to global markets, and no market was more important than the United States. Chinese factories expanded at historic speed. Ports along the Pacific coast processed more goods in a month than they once did in a year. Entire cities grew around export industries. Millions of workers entered the formal economy, producing goods that American households bought daily. The scale was unprecedented, and the cost advantage was undeniable. For American consumers, this felt like progress. Electronics, clothing, appliances, and tools became more affordable. For American businesses, outsourcing continued to raise profits. Investors rewarded these shifts, and Washington accepted them as part of the modern global economy. Few people focused on the deeper financial effect. Every shipment that crossed the ocean added more dollars to China's reserves. China treated those dollars not as spending money, but as a strategic asset. Its central bank purchased US Treasury bonds at an extraordinary pace. Each purchase had a clear purpose: maintain a stable currency, support export competitiveness, and build a financial shield large enough to withstand external shocks. But it also created a new dynamic. China became one of the largest foreign lenders to the United States, financing the very deficits created by American consumer spending. The United States, meanwhile, entered a period of expanding federal budgets, tax cuts, and military commitments. Government borrowing increased, and the Treasury issued more bonds to meet the demand. Foreign investors absorbed much of this supply, but China emerged as the most consistent buyer. The arrangement suited both sides. American policymakers viewed China as a reliable creditor. Chinese leaders saw U.S. bonds as both safe and useful, a way to keep their export engine running. Year after year, the cycle deepened. American imports grew. China's reserves grew. U.S. debt issuance grew. China's bond purchases grew. The relationship was now self-reinforcing and larger than any individual policy or administration. But during this rise, something else was happening, something subtle that would shape the next phase of the relationship. China began expanding beyond manufacturing. It invested in technology, infrastructure, logistics, and global partnerships. By the late 2000s, China was no longer simply the world's factory. It was positioning itself as a global economic actor with long-term ambitions. Part of this expansion was defensive. The global financial crisis of 2008 exposed flaws in a system that relied heavily on American consumer demand. China realized that holding vast quantities of U.S. debt linked its fate too closely to America's financial stability. It needed diversification. But diversification didn't mean stepping back. It meant using the leverage accumulated during decades of exports. China began deploying its capital abroad through state-owned banks and sovereign wealth funds. It financed infrastructure in developing nations. It expanded its presence in global markets. And while these initiatives served multiple purposes, they were made possible by the massive reserves originally accumulated through trade with the United States. The American side looked different. Manufacturing jobs continued to decline. Supply chains became more dependent on Chinese production. Retailers structured their inventories around Chinese factories. Meanwhile, Washington faced rising deficits and long-term commitments that required ongoing borrowing. Many policymakers acknowledged the imbalance, but reversing it would have required major structural reforms. Reforms that were politically costly and economically disruptive. Instead, the system continued, strengthened by habit and convenience. By the early 2010 seconds, the financial ties were deeply embedded. China held a significant share of U.S. Treasury securities. The United States relied on stable interest rates, which foreign purchases helped maintain. China relied on American demand to keep factories running. Both sides understood the interdependence, but they interpreted it differently. American leaders described the relationship as mutually beneficial, an example of economic integration. Chinese leaders saw it as a transition period, a stage on the path toward greater national strength. For China, the accumulation of U.S. debt holdings was not an end in itself. It was a tool, one piece of a broader strategy to elevate the country's global position. The rise of this system was steady, rational, and seemingly stable, but beneath it were mismatched expectations. The United States viewed the relationship as a permanent feature of globalization. China viewed it as a temporary arrangement that offered strategic advantages. These differences did not create immediate conflict, but they planted the seeds for future tension. By the time the world entered the mid-2010 seconds, the U.S.-China financial structure was no longer a simple trade partnership. It had become a framework of influence built through decades of borrowing, lending, and economic alignment. The United States depended on a steady flow of affordable imports and foreign financing. China depended on maintaining the leverage that came from holding large amounts of U.S. debt. The rise phase was complete. The next phase would reveal the hidden pressures inside this structure, pressures that would test how much influence debt can create and how much dependency a superpower can tolerate. As the U.S. China financial relationship matured, the flaws built into it began to surface. These weren't sudden shocks or headline-grabbing events. They were quiet structural pressures, incentives that encouraged short-term decisions, political miscalculations, and behaviors that gradually distorted both economies. What had started as a practical trade arrangement evolved into a system where each country's weaknesses fed the other's strength. For the United States, the central flaw was over-reliance. Decades of cheap imports had reshaped entire industries. Many American manufacturers found they could not compete with China's scale, labor costs, or state-backed support. Factories closed, supply chains moved abroad, and domestic investment slowed. The American economy shifted toward consumption rather than production, and consumption depended on borrowing by households, by businesses. This created a subtle moral hazard. The ease of borrowing made it simpler for policymakers to avoid difficult choices. Instead of addressing structural issues such as declining industrial capacity, long-term budget deficits, or an overstretched safety net, the United States leaned on debt to maintain stability. The presence of a large foreign buyer of that debt softened the urgency to change course. The problem was not corruption in the traditional sense, but something more systemic, a dependence that encouraged complacency. China faced its own distortions. The export-driven model that fueled its rise required constant expansion. To sustain this, China kept reinvesting its reserves into U.S. bonds, maintaining a currency advantage that supported its manufacturing dominance. But this model made China heavily exposed to American consumption patterns. Any slowdown in the United States created ripple effects throughout China's industrial core. Chinese policymakers understood this vulnerability and sought to reduce it by expanding influence abroad. State banks and investment arms increased their global reach, financing ports, highways, railways, and energy projects in dozens of countries. These loans, often issued with favorable terms up front but strict conditions later, created new forms of leverage. Some nations benefited from the infrastructure, others struggled under the debt. Regardless of the outcome, China extended its economic presence far beyond its borders. Meanwhile, the American government grew increasingly concerned about the depth of Chinese involvement in global finance, supply chains, and technology. But concern did not immediately translate into action. Businesses depended on Chinese manufacturing. Consumers depended on affordable imports. Financial markets depended on foreign purchases of U.S. debt. Any disruption to the relationship risked political and economic fallout. This tension shaped the next phase: competition beneath cooperation. Publicly, both countries emphasized mutual benefit. Privately, each watched the other's moves with increasing caution. In the United States, debates about China became more prominent. Concerns about intellectual property, industrial espionage, and national security gained attention. Companies questioned whether supply chains built around China were resilient. Lawmakers questioned whether it was wise for America's largest strategic competitor to hold so much U.S. debt. In China, confidence grew. Decades of consistent growth, expanding global influence, and financial reserves that ranked among the world's largest gave the country a sense of momentum. Chinese leaders believed their economic model offered stability and predictability compared to the political divisions and fiscal challenges of the United States. They viewed America's reliance on borrowing as a long-term weakness, one that could be managed but also used as leverage when necessary. Yet neither side sought open confrontation. The system still benefited both nations, even if unequally. The conflict remained structural, not military or diplomatic. It was a conflict of priorities, strategies, and vulnerabilities, a battle for influence, unfolding quietly through policy decisions, currency management, and financial flows. By the late 2010 seconds, the strains were visible. Tariff disputes and trade negotiations signaled a shift from cooperation to competition. Each round of talks underscored how deeply entangled the two economies had become. The United States wanted to rebalance the relationship, but doing so required unwinding decades of dependence. China wanted to maintain its advantages, but doing so required managing its exposure to American demand. This was the core contradiction. Both nations needed the system, but both were dissatisfied with what it had become. The stage was now set for a transformation. The flaws were no longer hidden beneath growth and integration. They were shaping policy, reshaping alliances, and forcing both countries to reconsider the cost of their dependence. The conflict had emerged not through war or crisis, but through the realization that the economic system linking the two superpowers could not continue unchanged. By the end of the 2010 seconds, the U.S.-China financial system had reached a point where continuation without change was no longer possible. The flaws were too large, the incentives too mismatched, and the political climate too strained. But the system didn't collapse in a single moment. There was no dramatic unraveling or sudden break. Instead, it began to transform slowly. The first major shift came through recognition. American policymakers, long accustomed to the benefits of cheap imports and foreign financing, began to acknowledge the strategic risk embedded in the relationship. Reports highlighted vulnerabilities in supply chains, critical technologies, and manufacturing capacity. Concerns about national security and economic resilience moved from the margins to the center of political debate. For the first time in decades, the United States publicly questioned the wisdom of relying so heavily on a geopolitical rival for essential goods and financial stability. China, observing these changes, adjusted its strategy. The country had spent years diversifying its global investments, expanding domestic consumption, and seeking greater control over key industries. It understood that the era of quiet integration was ending. The challenge was to reduce dependence on the American market without destabilizing its own economy. That meant gradually shifting from an export-driven model to one supported by internal demand. The transformation accelerated when global events exposed the fragility of international supply chains. Shortages in pharmaceuticals, electronics, and industrial components revealed how deeply interconnected and vulnerable the system had become. The United States realized that decades of outsourcing had left gaps in its ability to produce critical goods. China realized that its reliance on American consumers and technology left it vulnerable in ways it had not fully acknowledged. Both nations responded with policy changes. The United States explored reshoring certain industries, building strategic reserves, and investing in domestic manufacturing. China invested in technological self-reliance, renewable energy, and regional trade initiatives designed to reduce exposure to Western markets. Neither shift was complete, but both signaled the beginning of a long-term rebalancing. The financial relationship also began to shift. China gradually reduced the share of its reserves held in U.S. Treasury bonds. It did so slowly, careful not to disrupt markets or draw attention. The United States, meanwhile, expanded borrowing from a wider mix of domestic and foreign investors. Interest rates rose and fell with changing conditions, but the psychological certainty that China would always be the dependable buyer of American debt began to fade. Despite these changes, the relationship did not disintegrate. Trade continued, financial flows continued, cooperation continued in areas where both sides saw benefit. But the sense of inevitability, the assumption that the system would persist unchanged, was gone. In its place was a new reality, one where each nation understood the need to reduce vulnerability without severing ties entirely. The transformation also reshaped global perceptions. Other countries watched the shift and adjusted their own strategies. Some sought closer ties with China through investment and infrastructure projects. Others aligned more closely with the United States, viewing its alliances as a counterbalance to China's rise. The global economy, once organized around a stable hierarchy, now reflected a multipolar structure with multiple centers of influence. Through all of this, the central dynamic of the U.S.-China relationship remained. It became more cautious, more strategic, and more contested. China continued to hold a significant amount of U.S. debt, but it no longer expected that relationship to define the future. The United States continued to rely on Chinese manufacturing in many sectors, but it no longer assumed that the arrangement was safe. The transformation was not a collapse. It was an adjustment to forces that had been building for decades, forces that made the old system unsustainable. Both nations emerged with a clearer sense of risk, a more deliberate approach to economic policy, and an awareness that the next phase of their relationship would be defined not by convenience, but by competition and caution. When historians look back on the early 21st century, the U.S.-China financial relationship will stand as one of the defining features of global power. It reshaped industries, influenced policies, and altered the trajectory of both nations. Its legacy is not a single event, but a long series of choices that created a world where economic influence moved through debt, trade, and dependency, rather than territory or conquest. For the United States, the legacy is a reminder of how easily strength can drift into vulnerability when convenience replaces strategy. The country's reliance on cheap imports and foreign financing allowed it to maintain a high standard of living and avoid difficult reforms. But those benefits came with hidden costs. Critical industries weakened, supply chains stretched across oceans. Debt became a permanent condition rather than a temporary tool. The nation learned that economic dominance does not fade all at once. It erodes quietly through decisions that seem harmless in the moment. China's legacy is different but equally complex. Its rise demonstrated how a developing country could leverage manufacturing, exports, and financial discipline to achieve unprecedented growth. Yet the same strategy that propelled China forward also tied its future tightly to the economic behavior of other nations, especially the United States. The reliance on exports, the buildup of foreign reserves, and the purchase of U.S. debt created both power and exposure. China learned that influence gained through financial ties must be managed carefully, or it risks becoming a source of instability. Together, the two nations built a structure that reshaped the global economy. Their interdependence influenced interest rates, labor markets, geopolitical alliances, and the everyday lives of billions of people. But the relationship also revealed a broader truth. Modern power does not depend solely on military strength or political institutions. It depends on who controls production, who issues debt, who buys that debt, and who sets the terms of global commerce. The long-term consequence of this system is a world that is more interconnected, but also more fragile. No major nation today operates independently. Supply chains cross continents. Currencies move at the speed of algorithms. Debt links governments in ways few citizens ever see. This interconnectedness brings efficiency, but it also concentrates risk. A disruption in one part of the system can ripple across the world, revealing dependencies that many leaders prefer not to acknowledge. For ordinary people, the legacy is felt through rising prices, job insecurity, and the sense that economic stability depends on forces far beyond national borders. The decisions made by governments decades ago to outsource production, to run large deficits, to build reserves, shape the cost of living, the availability of goods, and the resilience of communities. What began as abstract financial policy became part of daily life. The deeper lesson in this story is not about blame or superiority. It is about the consequences of long-term choices. Nations rarely lose power suddenly. They lose it through accumulated dependency, through overconfidence, and through the assumption that the system supporting them will continue unchanged. The United States discovered that relying on a rival for financial stability carries risks that cannot be ignored. China discovered that tying its growth to the world's largest debtor creates a future that is powerful but uncertain. The transformation of the U.S.-China relationship is still unfolding. Both nations are attempting to rebalance, to rebuild strategic industries, and to reduce exposure to each other. But neither can revert to the world that existed before their economic ties deepened. The interdependence is too ingrained, the consequences too widespread. The story's final reflection is simple. Economic power is never static. It shifts with choices, incentives, and vulnerabilities that reveal themselves only over time. Debt can unite nations or divide them. It can create opportunity or dependence. The real question, the one that will shape the next chapter of global history, is whether nations learn from the patterns that brought them to this point, or whether they repeat them under new names and new circumstances. Thank you for watching this video. Click here to watch another video that might interest you.